Welcome back to The Exchange. You would think that these high borrowing rates would deter companies from wanting to take on new debt right now. But in fact, they are flooding into the debt market. Seema Modi is here with that story. What's going on, Seema?
A lot of activity, Kelly. Following a summer lag, 31 corporate debt deals have been announced just this week. That's totaling $54 billion, making it one of the highest volume weeks of the year. The duration of the deals announced this week are mostly less than 5 years. So on the shorter end of the curve, a sign that corporations are anticipating that rates will fall at some point. And demand has been strong. If you look at the type of deals coming to market in September, on average, 3 times oversubscribed, according to Chris Reich at Credit Flow Research. Fund managers tell us relatively tight credit spreads are incentivizing new deals, currently at the lows hit in March of last year when the Fed started raising rates, as well as the prospect of more deal activity. Philip Morris, Volkswagen, Nestle, BHP Billiton are among the companies announcing new bond deals this week. So really across different sectors, it's not really concentrated in one area, Kelly.
And it's what you said that, okay, yes, the Fed's raised rates to 5%, but if that spread is narrowing because people are a little more optimistic now, they might not have, this is the most privileged part of the business world, the ones who can tap corporate debt markets right now.
That's absolutely right. Having covered corporate debt issuance since the onset of the pandemic, when we saw an overwhelming number of travel and hospitality names, specifically the cruise lines, issue new debt, there really tends to be these pockets of opportunity when you see equities a bit more stable, credit spreads are tight, and it also tends to come ahead of a big event. Well, we're 2 weeks away from a Fed meeting, and next week a deluge of economic data, including the inflation report on Wednesday. So that perhaps is what is precipitating this type of move we're seeing in the debt market, but it's expected to continue as well.
It's a great point. I also wonder, you mentioned some of it's a little bit more short term, and maybe that's because companies want to be opportunistic if rates do fall, which, I appreciate, but I also wonder if they're forced to. I mean, do they have a sense that, why lock in high rates for such a long, it's kind of the flip side of what you're saying, but is it also that borrowers aren't quite sure if they want to commit to that period of time if the economic cycle changes for the worse?
That's exactly right. Rates may be high, but if you're taking out a 3-year deal, a 5-year deal, you still have the opportunity to roll over some existing debt or refinance at some point. So it's just taking advantage of these types of opportunities that tend to present themselves. We'll see if we continue to see more.
Busier than expected now, that's for sure.
Yeah.
Seema, thanks. Seema Modi.